Hi guys, you're welcome back to my course. It's financial accounting made simple. My name is Sanyaolu Oluwafemi Akintunde, and I'll be taking you through this part of the course as usual. So let's jump right into the course. For our learning objective, at the end of this lecture, I expect that you should have a working knowledge of the following. The definition of books of original entry. That is what we'll be looking at today, books of original entry, also known as subsidiary books. But you're supposed to also know the examples of books of original entries that we have, or the subsidiary books that we have. Also, you're expected to have a working knowledge of the format of the various books of original entry. And lastly, we're going to be looking at practical questions with relations to book of original entry and also the applications on how we can treat each and every one of these books of original entry. So like I said before, they are known as books of original entry, or they can be called subsidiary books. And sometimes we can also call them books of prime entries, as the case may be. So sometimes in the objective question, you can see which of the following uh, is also known as a book of original entry or as books of original entry. Subsidiary books are also known as books of original entry or books of prime entry. So let's dive right into it. So what are the books? What do we mean by books of original entry? Now for definition, books of original entry, these are books in which transactions, accounting transactions, are first recorded before they are posted into their various ledgers. They are the books in which accounting transactions are first recorded before they are posted to their various ledger accounts. So books of original entry are also known as subsidiary books, like I said before, and they can also be called books of prime entries, as the case may be. They are books, they are accounting transactions which are first entered into the books before they have been taken to their various ledgers. So examples of books of original entry. We are going to be looking at 6 examples of books of original entry. The first one we're going to be looking at is the sales day book, also known as the sales journal. The sales day book, also known as the sales journal. Usually the sales day book is used to record transactions that are made on credits, by credit sales. It is used to record transactions that are made on credit sales. Then we now have the purchases day book or the purchases journal. The purchases day book or the purchases journal. The purchases day book or the purchases journal is used to record credit purchases that are being made. Then we now have the returns outward journal or purchases returns. So you can see it as the returns outward journal or the purchases return. This is used, it's a book used to record any purchase that has been returned back to a supplier. So if we've purchased goods from a supplier and some of those goods are not good, we may decide to return those goods. And the book in which we record these purchases is known as the returns outward journal or the purchases returns journal, as the case may be. Then we now have the returns inward journal or sales returns. Of course, you know, sales is when you sell something, and when you sell something, you've given it out to a customer. Now, customers feel that that thing does not meet the required specification or the need of exactly what they need it for. So what then happens is they will return it back to the organization. So that is what we regard as sales return or returns inward journal. So the book in which we record those returns is those sales returns is referred to as the sales returns book or the returns inward journal. Then we now have the journal proper, or the general journal. It is called the journal proper or the general journal. Now, the general journal or the journal proper is used to record any other transaction that cannot be conveniently recorded in the other books of accounts. Any other transaction that cannot be conveniently recorded in other books of account. That means it does not meet the requirements of sales, purchases, returns inward, returns outward, or the cash book. It will be recorded in the general journal. Of course, all transactions will also be recorded in general journal. For anyone uh, that cannot be recorded conveniently in any of the other journals, will be transferred to the general journal or the journal proper. Then the last one is the cash book. The cash book only deals with cash transactions. That's to say, any transaction that is not occurring in cash would not go into the cash book. So from the diagram, we can see below, we can see credit transactions, and all those credit transactions are recorded in the general journal, purchases journal, sales journal, purchases returns journal, and the sales returns journal. Of course, we're still going to be looking at each of these transactions one after the other. Now, from the other example that we have on the left, from the diagram we have on the left, we have books of prime entries. Like I told you, they are called books of original entries or book of prime entries or subsidiary books. So we have our subsidiary books there. We have the sales day book and the sales returns book. You can see those ones inside your sales ledger, while the purchases day book and the purchases returns book can be found in the purchases ledger. For every other transaction, including the sales day book and purchases day book, will be found in the general ledger. So if you are not, if you cannot understand everything I've said, you can replay this video so that you can actually get a grasp of exactly everything that I've said. For the format, this is how a journal format looks like. Now, for our journal format, you'll notice the first thing you have there is the date. That is the date of the transaction. This transaction is on January 1st. The year will be stated also, whether it is 2020, 2021, 2022, that should be stated. So we have the date. The next thing is the amount, the account name, rather. The account name is the next thing. Now, the accounts that are usually affected are where this is where you record the account names that are usually affected. Now, depending on the transactions that has occurred, that is why we have our transaction stated in this way. Now, this is a compound entry form. Compound entry means one on one side has been debited. The same thing too, more than one side has been credited. You can see it. You have credited transactions, credited accounts here, credited accounts here. I'm going to explain that later on so that you'll be able to understand exactly what I've explained here. And lastly, for every journal, you need to have a description. You need to have a description of the journal. Now, how do we determine the description? You need to have a description of the journal. And the description is what exactly was that particular journal for. So you can see description of the entry. So for example, if we have bought a motor vehicle on credit, we are going to describe it here as being motor vehicle bought on credit. If we have made purchases on credit, it's going to be being purchases made on credit. So that's how we're going to record that transaction. So whatever transaction we've put up, we have to state exactly what the transaction is meant for. So let's go further. So let's look at simple entry transactions. Simple entry transaction, that's under our types of journal entry. We have the single entry, the simple entry, and the compound entry. So for the simple entry, every transaction must affect two accounts. Don't forget our double entry principle. For every debit entry, there must be a corresponding credit entry and vice versa. So for every transaction, there are usually two parties. For every transaction, there are usually two parties. One account is to be debited, while the other account is to be credited. So for a single entry or for a simple entry transaction, for a simple entry journal, one side will be debited and the other side will be credited. So that is why we have here, we bought furniture from Saul. We bought furniture from Saul. And the transaction is that if we are buying furniture, what happens? We have to debit the furniture account. Based on our accounting principles of debit and credit, we debit the furniture account and we credit Saul's account because Saul is giving. If Saul is giving, the double entry principle says debit the receiver, furniture account is receiving. So we debit furniture account and credit the giver. The giver is Saul's account and Saul account is being credited. So this is a simple entry transaction because it affects only one debit and one credit. At the end of the day, we still need to include the date of the transaction. You can see the date on the transaction on 10/04/2016. That's when the transaction took place, and that is why we have the dates here. And lastly, don't forget I told you that for every journal entry, you must do a narration or a description of that particular transaction. So here you have been furniture purchased on credit. Being furniture purchased on credit, as the case may be. So that's that about a simple entry transaction. So let's look at the compound entry transaction. Now, what is a compound entry transaction? A compound entry transaction, the compound entry journal is one in which more than one account is affected. That is, more than one account is debited or credited. We know this as the compound entry. So where you have more than one account being debited or credited in a single transaction, in a single accounting transaction, when you have more than one being debited or credited, then we say we have a compound entry. So let's look at this example. On the 16th of May, 2016, we paid $1,000 cash on account of salary and $600 cash on account of rent. We paid $1,000 cash on account of salary and $600 cash on account of rent. Now, if we are going to record this, don't forget this is a single transaction. The transaction occurred at the same time, but it affects more than one account. So the first one is, if we are paying for salaries, of course, salary accounts will be receiving. And so what do? We debit. The same thing too with rent account. If we are paying rent, rent account will be receiving. So we do what? We debit rent account. So you can see we have debited both salary account and rent account. But what did we pay with? We paid on both accounts. We paid with what? Cash. So we have a cash of 1,600, while the accounts of salary and rent is splitted between 1,000 and 600. It makes it 1,600. So this is a compound entry. So you can see the narration being salary and rent payments, being salary or being payment for salary and rent, being payment for salary and rent. So let's continue. The next one, we are going to be looking at the sales day book or the sales journal. The sales day book or the sales journal. This is a book of original entry used to record all goods that are sold on credit. I've said that before. Any goods that are sold on credit will be recorded in the sales day book or the sales journal. Any goods that are bought, that are sold on credit rather, any goods that are sold on credit will be recorded in the sales journal or the sales day book. So let's look at this example. On the 12th of February 2022, credit sales to Rose. Credit sales to Rose. That means we have sold to Rose on credit. And don't forget, there is no involvement in cash here. So that does not involve any cash transaction. The transaction was made on credit. So what do we do then? We debit Rose's account because Rose rather would receive. Rose is receiving. So since Rose is receiving, we debit Rose account, although Rose is also a debtor, or we call that account receivable. While sales is being credited, the reason why sales is being credited is that sales is giving. Of course, when you make sales on credit, you're giving out an item, and so you credit sales account and you debit. Sorry about that. So you credit sales account and you debit Rose account. Being goods sold on credit. Being goods sold to Rose on credit. So that's about that. The next one we are going to look at is the returns inward journal, or the sales returns. The returns inward journal or sales returns. Now, what do we mean by the returns inward journal? This is a book used to record goods that were previously sold to customers, where goods are previously sold to customers but were returned later by those customers. So we have sold these goods to customers, but one way or the other, the goods were returned. Now, what are some of the reasons why the goods that we have previously sold to a customer may be returned? One, it may meet the wrong specification. It may not be the right specification of goods. So if the goods are not within the right specification, they may be returned. There may be shortage in quantity. If the goods were supposed to be 30 in a crate and we ended up giving them 25 in a crate, that could be what? Returned. It could be deficiency. It could be color problem. That means there could be a problem in the color. Maybe some person wanted black but was given blue. It could be in respect to wrong size. The person may be wearing a size 43 and you have transferred a size 40 to the person. So all these are reasons why goods that are previously sold could be returned. So let's look at this example. On the 21st of February 2022, Rose returned goods worth 20,000. So Rose has returned goods worth 20,000. So what happens? We debit our returns inward accounts. We debit our returns inward account or sales returns account and credit Rose's account. Now, Rose is giving. That is why it is being credited. While sales is receiving, that is why it is being debited. You can see it here. Being goods returned by Rose. So Rose is returning, we credit. We are receiving from Rose, we debit. That's the double entry principle. Debit the receiver and credit the giver. If you are not aware of this principle, kindly go back to our course on debit and credit. The next one we're going to look at is the purchases day book or the purchases journal. This is a book of original entry used to record all goods that are purchased on credit. All goods that are purchased on credit with the intention of resale. So we bought these goods from our suppliers with the purpose of reselling the goods. All goods that are purchased for the purpose of resale. So for this example, on the 3rd of February 2022, credit purchase from Hot Eyes Limited, 50,000. So we have made a credit purchase. So what happens? We debit our purchase account. We debit the purchase account with 50,000 for receiving, and we credit what? Hot Eyes Limited account. We'll credit Hot Eyes Limited account because they are the one giving the product or the goods that are being purchased. So we debit our purchases account and credit Hot Eyes. Hot Eyes is a creditor, or we call them accounts payable. Lastly, you have to put a narration So our narration will be being goods purchased from authors on credit. Being goods purchased from authors on credit. Returns outward journal or purchases return. Now it is possible that the goods that we have purchased from our suppliers, some of them may be defective, some of them may not meet the right specification, they may be deficient, they may be the wrong size. What do? We have to return those goods. So this represents goods that were previously bought from a supplier for the purpose of resale, but do not meet the required specification that we need. And as such, they need to be what? Returned. So it might be the wrong color, the wrong size, shortage in quantity. All these may require that we return such goods. For example, on the 12th of February 2022, James returned goods worth 20,000. So let's assume James previously bought those goods and has decided to return goods worth 20,000. Now, when he returns goods worth 20,000, then what then happens? We debit hot ice account. We debit hot ice account, so that should have been hot ice. So we debit hot ice account for returning, and we credit returns outward account. The credit returns outward account being purchased goods returned by hot ice. So this James should have been hot ice. Sorry about that. It should be hot ice limited. So let's look at the general ledger or the journal proper. General journal or the journal proper. This is one of the books of original entry used to record any transaction that cannot be conveniently recorded in any of the subsidiary books. I've said that before. It is used to record any transaction that cannot be conveniently recorded in any of the subsidiary books. For example, when you make purchase or sale of non-current assets, when you make purchase or sale of non-current assets, bad debt written off, correction of errors, all these can be done using the journal proper or the general journal. So don't forget, whenever we talk about purchases or sales, we are referring to inventory. But when we talk about purchases of sale of non-current assets, we are referring to assets. The difference is that purchases and sales refer to inventory that are bought for the purpose of resale. Why for non-current assets is not usually so, except it is in the business of that particular organization to be in the sale of assets. That means if a car company, a company that sells car is buying and selling cars, then their cars will be referred to as inventory. So let's look at this example. On the 18th of February 2022, bought a minivan on credit from Eva. Bought a minivan on credit from Eva. Now, don't forget, we are buying a minivan. When you buy a minivan, you debit the minivan account because the account is receiving the van. So you debit the asset account, which is called the minivan account. Eva is the one giving out. So what do? We credit Eva's account because Eva is a creditor. We'll call them account payable. Then the narration is being motor van purchased on credit from Eva. We then look at the cash book. This is a book of original entry used to record all transactions involving the sale, purchase, acquisition of property, and other receipt of payments in cash or by cash. So any transaction that involves cash, whether you are selling inventory or you are giving out assets or you are buying assets, in as much as that transaction is a cash transaction, it will be recorded in the cash book. Now, the cash book is divided into two sides. We have the debit side and the credit side. We have the debit side and the credit side. All transactions that are received by the organization will be debited. All transactions that are all cash transactions that are received by the organization will be debited. Why all cash transactions that are given by the organization, that has gone out of the organization, will be what? Credited. So at the end of the period, we are going to add up all the debit side and add up all the credit side. The difference will be the balance, and the balance will be taken to the next period. So at the end of a weekly, daily, or monthly time, we are going to add up the debit side and the credit side. The difference will be the balance that will be taken to the next period. So we have different types of cash book. We have the single column cash book, we have the double column cash book, we have the 3-column cash book, and we have the petty cash book. So we're going to be looking at each of them in another part of our course. So this is a cash book format. So for the format, you can see the cash book is divided into two. You have the debit side and the credit side. Now, at the debit side, you can see you have the dates, you have the particulars, you have the folio number, and you have the amount. And the replica is also on the credit side, the dates, particulars, folio number, and amount. You can see the date contains the date of the transaction. So this is capital used to start the business. So when the owner of the business commits capital to the business, you can see it is debited. It is debited because money has come into the account. Also, when you make sales, they are going to definitely give you cash. That's when you make cash sales. They are going to give you cash, and so it will be recorded on the sales. If you have investment in another organization, that investment and they pay you dividend. Dividend will be an income, and as such, it will be recorded on the debit side of your cash book. So now let's look at the credit side. The credit side has to do with all transactions involving funds leaving the account. So the first one we are going to look at here is we are going to look at motor vehicle. So assuming that the organization bought a motor vehicle, the value of the motor vehicle will be recorded here because money is leaving the organizational account. Then when you make purchases by cash too, it will be recorded on the credit side, as well as electricity bills and repairs. You can see they are all recorded on the credit side because it involves the outflow of cash, while the debit side involves the inflow of cash. This deals with the outflow of cash, while the debit side deals with the inflow of cash. So at the end of the day, we are going to add up everything here and add up everything here. So the difference between what is here on the debit side and what is on the credit side is what will give us the balance. So let's assume this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That is 10 on this side. Is that not so? Here we have 1, 2, 3, 4, 5. So 5 minus 10 will give us 5. That means this side, the debit side, is more than the credit side. It's as simple as that. So the balance will be written on this side. So we add up all this together, it will give us this. We add up all this together, it will give us this. Now this balance will be transferred to the beginning of the next month. The same thing would happen if this side was more. So if this side was more, the balance will appear here. That means on the other months, it will appear on this side. So it depends on the type of transaction that has taken place. So let's look at this example. Example of single column cash book. Coldstone Nigeria Enterprises commenced business on 1st February 2022 with the sum of 500,000 cash. Now, we are commencing business with the sum of 500,000 cash. That is capital. So capital will be recorded on the debit side because we are receiving funds from the owner. If you remember our business entity concept, which says that the business must be separated from the owner. It's as simple as that. So the 500,000 will be recorded on the debit side. Now, the following transaction occurred in the month of February. So the first one is on 1st of February, bought motor vehicle by cash. So what do you think bought motor vehicle by cash would be? from the idea of everything you have learned. So when we buy motor vehicle, what happens? Cash is leaving the organization. So what do? We credit uh, our cash book. We credit the cash book. Then what else? On the 3rd of February 2022, purchases, we made purchases of 50,000. So what do? Debit or credit? Debit or credit? Of course, you got it right. It is credit. We credit because money is leaving the account. So we credit the purchase, the cash book. We credit the cash book. Settled NEPA bill on the 5th of February 2022. Settled NEPA bill. So what transaction will be? If you are paying for NEPA bill, what happens? Money leaves the account. And when money leaves the account, what will happen? What do? Do you debit or you credit? Of course, you got it right. You credit because money is leaving the account. On the 6th of February 2022, credit purchases from daily. Credit purchases from daily. So we have made a purchase from daily. Now, when you make purchase from daily, what happens? Credit purchases. Now, credit purchase will not appear in the cash book. The requirement of this example says that we should prepare, we should post the transaction above into the cash book. But because credit purchases does not come into the cash book, we are not going to record it in our cash book. What we are supposed to do is to create a credit journal. We're supposed to create a what? Credit journal, or a sale, or a purchases day book rather. We're supposed to create a purchases day book. So that does not appear in our cash book at all. I've said that before. Anything credit does not appear in our cash book. Now, on the 9th of February 2022, repairs of motor vehicle. When you repair motor vehicle, of course, you have to pay them for the repairs. Is that not so? So what happens? Do we debit or credit? Debit or credit? You have 2 seconds more, debit or credit. So the answer is that we credit. We credit because money is leaving the account. Then on the 12th of February 2022, cash sales. When you make sales, what happens? They will pay you. Is that not so? They pay you by cash. So what happens? Do we debit or credit? Debit or credit? The answer is debit because you are receiving cash. You debit. On the 14th of February 2022, sold goods to Grace on credit. We are seeing another credit transaction. Sold goods to Grace on credit. Credit transactions do not appear in our cash book. We don't have any business with credit transaction. So if we're to record it in any of their books of accounts, what book would that be? You have 5 seconds. What book would that be if we are to record this in any of our books of accounts, outside any of our subsidiary books? So you got it right. It is in our sales journal, sales day book or sales journal. On the 16th of February 2020, bought goods on credit from Ronaldo. We are seeing another credit transaction. So that should be recorded in our sales day book because it has to do with credit transaction. On the 18th of February 2022, bought minivan on credit. Bought minivan on credit. This also would not appear in our cash book. I've told you, cash book only records cash transaction, only records cash transactions. Then on the 21st of February 2022, sold goods to James Blunt on credit. You can see credit transaction does not appear on our cash book or does not appear in our cash book. And as such, that transaction would not go to cash book. So you can see from our examples, you can see all the transactions that we have put there. You have the capital accounts, you have the sales. All these transactions were transactions that were made on credit, on cash, by cash rather. All these transactions were transactions that were made by cash. So at the end of the day, if we add up all these sides, If you add up this, that will give us 600,000. If you add up all the transaction here, that is 200, 250, 270, 280,000, which all transaction is 280,000. But in order to make this to balance, what do? We subtract 280,000 from 600,000. That will give us 320,000. And this 320,000 is cash that we are going to move to the next month. That means that after receiving 600,000, we have paid out 280,000. So we have a balance of 320,000 that will be taken to the next month, which is March. So as usual, I always give assignments and expect that you should try your hands on the assignments. You have assignment 1 there about Divine Favor Enterprises, recommend business on 1st January 2016 with cash of 1 million. So I expect that you should be able to solve this problem. Also, you have assignment 2. So you should try your hands on the assignments and see how far you have learned. I want to suggest that before you try your hand on the assignments, you try as much as possible to watch the video maybe once or twice so that you can get a full grasp of the explanations. So like I always tell you, accounting is very easy. You can see, you can draw inspiration from my failure and be able to work on it and improve on yours. Accounting is very, very easy. You just need to be committed. So failure is the ability to start again more intelligently, and mindset is what distinguishes ordinary from extraordinary people. Numbers don't lie, it only shows pattern. If you study for 30 minutes every day, you cannot compare yourself to a person that has studied for at least 3 hours every day. Result would always show. So you can reach me on any of these social media platforms if it's required. Thank you for watching, and you can subscribe to my YouTube channel if you want to get more of my video content. And at this point, I'll see you in my other videos. Thank you very much for listening. Adios, Domingos.